everyone, and welcome to the week ahead. Today, we are joined by George Robertson, Tracy Shuchart, and Albert Marco will make it a little bit late. We're talking through a few things. We've got a lot to talk through with George. The first is a July rate cut, and we'll go into a lot more details from there. With Tracy, we're talking about Natgas. We saw some pretty dramatic price action on Natgas on Wednesday. We're going to talk through some of the seasonal dynamics of Natgas and some of the impact on downstream industries from Natgas. And then when Albert's back, we'll talk through tech and bonds and the impact on VIX with this kind of thesis that he's had for the last, 6-12 months. So we'll talk through that. So George, thank you for joining us. I know we've been in touch for quite a while, and I'm really glad that we could finally have you on. So you have decades of experience in markets, and in reading through your newsletters and your comments on social media, I really enjoy how you intertwine markets and politics. I think that's really fantastic. We won't name names, but there are people who believe that one kind of has nothing to do with the other, and it's a pretty limiting point of view. So I want to jump right in and talk about a tweet that you had from this week. You seem pretty convinced that we'll see a rate cut in July. I think there's consensus that we'll see September, but I'm just curious, what's your case for a July rate cut?
Okay, well, first, Tony, thanks for having me on. Tracy, good to meet you. I think it's got to do with my my overall framing of where the Fed is now and how it got here. I'll try to make it as brief as possible. That as far as ex post analysis of the Fed, like looking at what has actually come about given changes in Fed policy, there's absolutely no sign of the Fed having an impact on the economy or on inflation since about 2012, 2014. As I said, this is ex post. And I'm actually sort of surprised that practitioners aren't just looking at the data. There's a lot to do about the Fed going to cut or going to raise in the past. There's a lot to do about what Powell's saying in front of Congress. There's a lot to do about all the myriad amount of Fed speakers all the time, often sort of chattering away from my point of view. Yet nobody's looking at, well, what have they done? And I think what people are doing is that they're looking at the hard-won or schooled lessons they had on what the Fed was doing and how they did it, based upon the legacy from Volcker 1979 to early Bernanke. And they think that it's safe to just have a continuum of that knowledge to today. And what that misses is the very radical changes in Fed policy, a complete revolution, which academically is called the change to Neil Wicksell and Woodford. It started with Woodford's speech in front of Jackson Hole in 2012. Now, what this gets into the Fed in July is that with this change, the Fed basically stepped away from current management. There's no reaction function now. Powell uses those words at times and others freely use it, but there is no reaction function. The Fed has no idea what a rise in 25 basis points in Fed funds will do to labor or to inflation, nor do they have any idea what a 25 basis points decline in Fed funds would do to labor or inflation. Of course, that used to be the Rosetta Stone for understanding the Fed was what is the reaction function. Taylor made this written on granite in 1993, but that doesn't exist anymore. And so the reaction function is actually just an abstract, or actually is ignorantly used in terms of the current monetary policy. The monetary policy is a mix between macroprudential, like a very increased set of rules and regs that they have to oversee the system banks, put in play Dodd-Frank and various other add-ons since the GFC. But the actual monetary policy was put into forward space, 3 years forward, 2 years forward. And they felt strongly, and I won't get into too much of the detail of it, but they feel strongly that you don't have to worry about the here and now. You don't have to worry about what's happened in the last 6 months, because we're going to have a lag. We're going to have what's called a cumulative process, which, by the way, is a word they stopped using about last year. And eventually we will get to where we want, which is expressed by the forward expectations anchoring. The trouble is it doesn't work, and it has shown no signs it is going to work.
George,
So that the Fed is totally political now. It really
oh, it
has
is.
no monetary economic underlying capability.
Yeah, that's great. I want to get there, but you mentioned this 2012 Wickford speech. Can you talk us through what happened there? Because it's not something that I've really paid a lot of attention to. So can you give us a little bit of a history lesson of what he said there and why that's important to today?
I put the Woodford speech at Jackson Hole on 2012 at the request of Bernanke, as far as I can figure out. Every bit as important as Taylor's 1993 paper on the Taylor rule. And what Woodford said, and if you look back, Bernanke first started talking about Woodford as early as 2003. And what Woodford said was then just a tactical point, was that if the Fed couldn't adjust Fed funds, at that time they couldn't because they're at ZIRP, as per the Taylor rule, or at that time, monetary economic ideas of the reaction function, then they would change to Woodford type policy setting, which is to control the forward space, control forward expectations, and depend on the 30 years of knowledge and trust that people had in the Fed, that if the Fed says they're going to sit on the fence, that'll be the time the fence will fall down. So if they orchestrate, control, and even impose the narrative for what is going to happen in terms of the results of Fed policy 2 years from now, 3 years from now, that is monetary policy now, and it will come about. There's some things about the VIX and the natural rate and such, but that might be a longer show. So they're only concentrating on what I think is clearly propaganda to control this forward expectations. And I don't mean propaganda as a diss. There's good propaganda and there's bad propaganda. There's truthful propaganda and there's also just the big lie. But there's only the only monetary policy is to convince Nick Tamiris that if he wants to keep his job at the Wall Street Journal and various other people, if they want to get that midnight call or even a one-on-one with Powell that's top secret, but no other reporter gets it, they will toe the line, ask the questions that are given to them into the presser, and also write up articles that are in line and in sync, if not dictated by the Fed's propaganda machine. This is then carried on into the general narrative. Most of my peer group, if I don't know if they would like to call me a peer, but on X Space and also Substacks and even in the street, are completely in bed and have been institutionally captured by this ferocious propaganda machine that the Fed put together, which they think is crucial for their ability to implement monetary policy in forward space. Bernanke himself mentions this in his latest biography about, I'm a brave man. I can't remember what the title was, where he talks about how he orchestrated with great attention to Michelle Smith, the head press agent, or whatever she's called at the Fed, on selecting certain reporters who were bright enough to understand the complexity of monetary policy a la Woodford, and then he would have one-on-one on them well before the rest of the pack, and certainly before the pressers. This is still carrying on. Now, what this all means is that there's a blind spot in terms of understanding what the Fed will do or can't do, and certainly in the interpretation of what has been done. And I think that comes up to now is that the whole question about Fed funds being cut is based upon what will enhance the ability of the Fed to control the forward guidance and control the political impressions to Congress and also to the public, rather than what the monetary economics might be in that cut.
Okay. So, I'm just curious. So when we look at this time around, it seems to me that there is something different in as much as we have very active fiscal policy through Yellen. And when Yellen was at the Fed, she really jumped up and down about the fact that there was no fiscal to support her activities at the Fed. So, I'm wondering, we don't, in fact, have a ZIRP policy, but given the fiscal intervention we have, is that not offsetting some of the, marginally restrictive monetary policy we have out of the Fed? And could that not be, I don't know, aligning with some of the views that you're taking about expectation setting? So the Fed is setting expectations, but the Treasury is also pushing tons of money through fiscal policy into the market. And those two really are offsetting each other to some extent, although we've got an appreciating dollar. I mean, it's much more sophisticated than that, but on some level, in my mind, that's kind of what we're seeing. Is that plausible in terms of what I'm outlining?
Well, I'd be even more dramatic, but I think it's actually just a pragmatic read of the data, is that the Fed doesn't matter as far as what you're talking about. If you were to look at any sort of flow that you can identify that emanated from the Fed, either through the system banks or through RRP or whatever, all the things that people claim is QE, QT, the actual amount of money that's gone into the system cumulative since COVID is about maybe 250 billion now. It's really a nothing. Yet, however, the fiscal spend's obvious.
Right.
There's a 7.5 trillion gross amount that's cumulatively come into the economy since COVID. And of course, we've had very large tax receipts given the Keynesian nature of the pump priming that the COVID remedy did, followed by other policy. But that tax receipts is coming from the upper cohorts,
Right.
The usual tax, and an unusual large chunk of that 7.5 trillion went to the lower cohorts. It was basically one of the largest redistribution of wealth. If you think about taxes, who eventually has to cover this stuff, that the U.S. has ever gone on. It dwarfs any sort of Great Society or any sort of previous policy, and it was massive. The Fed's flow is just talk. And maybe in the end it will work. I mean, maybe next year in Jerusalem, the Fed will actually produce something. But you can't find any dollar amount ex post that shows that the Fed has had any impact on NGDP, disposable personal income, personal consumption expenditure, retail sale, blah, blah, blah. There is no Fed as far as the show me type of analysis.
Since we've kind of gone off onto this, let me ask you. So, when the Fed was put in place, they really were put in place as the lender of last resort early on. And that's really what central banks have done since the beginning of time. Over the last probably 50, 60 years, we've kind of been pushed into this inflation jobs kind of narrative about central banks. But in reality, really since central banks started, they've been put in place to be the lender of last resort. And so when I look at, say, commercial real estate right now, the Fed has been the support for these regional banks to keep them in business. And as we saw in the financial crisis, they, created the phrase systemic bank, right? And so I don't want to appear as being defensive for the Fed, but in terms of being kind of the lender of last resort, they're definitely doing that. Like, it's easy to give out money, right? And so you see a problem, we'll throw money at it and keep the system afloat. And they really are kind of the bumpers on the bowling alley more than, say, a precise instrument to manage economic performance. That's kind of how I see them. Although there's a lot of debate about, will the Fed cut? Will the Fed raise? Will QT? Blah, blah, blah. You know, when you have an active US Treasury like we do now, which isn't often the case, and hasn't been for quite some time. Yellen's been incredibly activist, right? When you have an active fiscal, I think it's hard for the Fed to have an impact on jobs and on inflation and other things. Although they're getting a lot of criticism and or credit for their job. I don't think they've done a terrible job, but they have less control because there are many, many more variables in the system with Yellen at the helm than there have been in the recent past. Is that a fair assertion to say?
I would agree in terms of the Badgett Lombard Street role for central banking, lender of last resort, lend freely against good collateral. And that is certainly what they did in the GFC. I mean, God help us if the Fed wasn't there. But the QE, all the other machinations were not required. After they did their first 700 billion or so to and various other things to rescue, well, not rescue, but clean the mess up of Lehman, they're done. And all the rest I see as embellishments or
it's corruption. I mean, come on.
Yeah.
It's capture, it's corruption. It's
and they came through with and Bernanke was riding high, and I think a lot of it was sort of a utilitarian idea that we must have these Dodd-Frank suite of laws and regs. Otherwise, these banks are going to, they almost killed us, and they are going to kill us if we don't get a handle on this.
And they always do. In every cycle, they do, right? In every
Right.
country, in every cycle, the banks really do drive off the cliff, and the central bank comes in to build a very expensive road underneath them.
Right. And I think that this was communicative. It was signaling. Actually, Bernanke says that QE was a signal. The Fed itself has dropped talking about QE being an add to the economy or QT being a drain. And now they talk about it just in terms of whether it's abundant or ample reserves, which is what QE is. It's reserve management, which goes back to what I think the Fed is really after, is to strengthen, enhance, and maintain their very powerful set of Dodd-Frank and other regs rules that came in so they can implement macroprudential policy. It is not monetary policy, though.
Right.
So I might debate with you by saying that the whole reporting to Congress that they must do twice a year is solely based on a vocabulary of monetarism on money and ex post analysis, and very little to do with ex ante. Think of first of all, Volcker would just blow smoke at him, literally, and then Greenspan's dance, and then Bernanke's early Bernanke. Now it's just total bullshit. They are not complying to law. They're not reporting as a monetary institution. I don't think, Tony, I think it's worse than you think. I think
have you met U.S. Congress? I mean, you know these guys are not the smartest people around, right? A couple of them are really smart, but most of them are total tools. So they can ask questions. They don't really know what they're talking about.
I don't want to agree, but I never thought I'd say the day, but I really miss Barney Frank. At least he would spittle flying and all. He would make Greenspan dance. Talk a good game. But the Congress is in charge, and it's in charge based upon various laws, the recent laws, Dodd-Frank, and also the Humphrey Hawkins, and it's solely based upon an ex post monetary policy.
Sure.
It's not based on this ex ante Neil Wicksell Woodford type of approach.
Sure.
So I think the Fed's committing perjury. I know that's a big technical charge, and I think they're going to get it in the neck because there's going to be a crisis, a problem, because we need a Fed. We must have a Fed. it's a threat to democracy if we don't have an active, good Fed with an active, good monetary policy, for good or for bad, but at least something that can be followed and criticized or amended or applauded.
Sure.
Right now, there is no policy. So if we really get into a big jam like a GFC, the Fed's an empty suit. So after their budget rescue, they got no game. And that's where it's going to be really interesting.
Yeah. So, okay. So having said all that, which I think is really interesting from a kind of theoretical and executional perspective in terms of the institution itself. But why now? Why a July cut? Why is now important? If there really is no efficacy from the Fed, then why do you think it's going to happen in July?
Well, I think people are, I mean, just the very fact that, he's saying it's restrictive and the market goes up in his face to 56 plus, even today's sell-off is still, it's a market that's increased 100% since the COVID lows. And so, and that's just the S&P.
Right.
So people got to start wondering, like, what the hell's the Fed actually doing? What is this restrictive talk? We got the bizarrely tight labor. We got every risky asset there is going up, even Bitcoin. Everything is like charging to the moon. It's sure as hell not behaving as if the Fed is restrictive or tight at all. In fact, people are going to start to say, which I think some people have already said, I think the Fed's at ease. And what does that mean about what they've said to date and what they say they can do going forward? So I think the Fed needs a big boom. They need to stir things up, cover their ass, impose a lot of drama and focus, bring it from the forward to the here and now. Get Nick Tamaris online to do whatever, and send everyone Waller out and the whole crew out. They'll even probably send cash and carry back out.
Okay. So if they were to do it this month, given what's happening with Biden, and given like the tech fears that we had yesterday, all the things are back a little bit today. We'll talk about that later in the show, but would it look suspicious? I mean, we're not quite where we need to be on inflation. We're not quite, in a place where, I mean, jobs are okay, but our jobs are fine. At least statistically, they're fine. In reality is a different question. But does it justify it from a, I guess, political perspective, or would it look? What I worry about a July cut is that it looks too political, given the. Sorry.
Mature, I think is the word you're looking for. It looks premature.
It looks premature, and it looks like it's trying to rescue either Biden or his, whoever's going to fill that spot. It looks like it's trying to rescue the current regime, given how terrible their optics are right now.
I would agree with you, but I think it's clear that the Fed will be challenged as it is now, given the Trump administration. And if J.D. Vance forms a 2, we'll get into Congress in either Senate or House. If Marjorie Greens will have a bigger voice. All this stuff means that I think the holiday that the Fed's been granted by Congress is coming to a quick close. So I don't think the Fed can afford, if they're as mercurial and as political as I think they are, they can't afford a Trump presidency. So as you say, Tracy, the timing is key. I think we might all be in agreement that the Fed is going to come to do all they can for the Democrats and the Biden election prospects. But I think the time is now, given it's just since this is all political now and not quite a fantasy, but all a writing a book type of thing. I think that the Trump assassination attempt, all the press he's getting, this hugely successful RNC convention, Vance has got a leg on, Vance and Bitcoin. He's not a friend for the Fed in the least bit. They're I think they're going to panic. And
Yeah,
I think
I think all you have to do under a Trump administration is have a Treasury Secretary who isn't as activist as Yellen.
Yeah.
And if you have somebody who is less activist than Yellen, it pushes a lot back onto the Fed that they were doing before Yellen was the Treasury Secretary. And it really puts them into the hot seat in terms of performing. So I kind of align with you in that the Fed over the last 4 years, on some level, has been a little bit of a showman more than anything. And Yellen has kind of made their job a little bit easier, although she's accelerated inflation with her massive fiscal dumps, right? So, but she's really, really helped the economy look a lot better than it, to be honest, it probably should be doing. But so if we do have a Trump administration, and I'd be curious for both of you guys to let me know what you think about this. The RNC has been going on for the past couple of days, and like you said, George, it's actually been pretty successful. I think previous RNCs have kind of looked a little bit clownish. This doesn't really look that way. It looks like old school 80s type of convention, and it looks serious and it looks inclusive. And so if the odds of a Trump presidency are as high as some people say, I know Albert doesn't believe that they're that high, but if they are high, and we do see a Trump presidency, how do you think that will change certainly the monetary environment, but potentially also the fiscal environment in the US? George, why don't you go first, and Tracy, then we'll get your view.
Okay, I think fiscal is sort of baked in. The cake is baked. We spent so much money on COVID, and then we followed through with CHIPS Act and various other Inflation Reduction Act and various other infrastructure acts. The whole span was almost like a wartime footing, where Congress gave up their Article 1 powers of the purse and just said, "Oh my God, we have an I don't want to be flippant. We have an existentialist risk of COVID. So just like at any wartime footing, president's now in charge." And Trump started this, but Biden just ran with it.
Yep.
And this is going to take a good decade, just like World War II took a good decade plus to calm things down, or World War I. It's going to take a good decade before Treasury really has any choice in terms of how much debt they have to issue, and the progression of debt. And more importantly, probably Congress has no choice. We spent this money, so it's got to be financed. There might be some knuckleheads that get into Congress, especially Republicans, who adopt sort of a Newt Gingrich type approach that we got to reduce the deficit no matter what type of stuff, and that could be really problematic to the economy. And it has to be, though, on the size of $2 trillion. So I think it's all baked in the cake. I don't really think the next 4 years has much choice about the fiscal policy.
Tracy, what do you think?
As far as fiscal policy is concerned,
Well,
I mean,
if we do see a Trump administration, how do you what impact do you think that would have on the Fed and potential fiscal policy?
well, I think that Congress is going to spend no matter what. So let's just call a spade a spade. Nobody's going to stop spending. They're just
Free
not.
money.
I mean, I don't care what party is in office, and you may disagree with me on that, but I've seen nobody except for very few representatives or members of the Senate say we want to, reduce spending. Literally you can count them on your left hand. So we have to be serious on this. Now, what I think is interesting is if we have a Trump administration, he's already talking about huge tariffs on China. We know that, and we know Vance is also very kind of bullish anti-China. He's more worried about China than pretty much any other country. So we could see really big increase in tariffs, which actually would serve almost as a tightening in some respects, as far as fiscal policy is concerned. But that said, I think there's a lot to think about. I think the China tariffs are going to be a big issue. Do not expect Congress to stop spending anytime soon. And I think they'll look to, say, increasing tariffs on other countries to kind of increase revenues for the US to kind of offset their fiscal spending.
Sure, yeah. Well, my one thought on the tariffs, because I know there's a lot of, hand wringing over tariffs. And, if we look at the, I think it's the Department of Commerce analysis over the Trump tariffs in 2017, the conclusion they came to is most of those tariffs were subsidized by the Chinese government anyway. It didn't really hit the US consumer. The Chinese government subsidized that so that the import price, the landed cost, would stay about the same. So if we saw a 10% increase in tariffs in the US on Chinese goods across the board, we may see a significant rise in subsidies from the Chinese government, so the landed cost could remain the same in the US. So is that absolutely going to happen?
We're actually seeing that in the solar industry right now.
Yeah.
I did something on that right now, is that you have these Chinese-owned solar companies within the United States that are not only getting subsidies from the Chinese government, but they also qualify for subsidies under the IRA Act.
Right.
So they're getting double subsidies. And so these companies are outperforming any American-owned companies, which kind of negates any kind of tariff.
Negates the IRA, right? It's just, it's more of importing CKD, like knockdown goods, and assembling them here. And, it's incremental, say, jobs, but not kind of a stepwise change in jobs. So I spent a lot of years as a trade analyst, understanding world trade and looking at data and looking at subsidies in China. As you guys know, I spent 15 years in Asia looking at subsidies in China and non-tariff barriers. And I'm falling more in line with thinking that the Chinese government will subsidize those exports more than it will hit US consumers. And I think US consumers are in a place where they don't just want to see inflation at zero. They actually want to see deflation. American consumers want to see deflation. So with the Fed getting to 2%, that is definitely not the destination. The destination is negative 2% for a couple of years. And I know that's not a popular thing to say, but that's what US consumers want. Because I don't think anybody thinks we're going to get back to 2019 prices on things. But I do think that, when people go to the grocery store, when they go to buy clothes, whatever they're doing, they want to see those prices come down, particularly in services. There's goods prices they want to see come down, but there are services prices they want to see come down as well. So how will that happen? I don't know. I'm not paid enough to think through those policies, but I really do think that the American people want to see outright deflation for a period of time, not just inflation stopping at 2%. Does that make sense to you guys?
I think about the tariffs and looking at like the legacy. There's some really bright guys behind Trump's economic policy. I mean, to just dismiss it as bombast is a huge error. There's Peter Thiel, there's Lighthouser. I think guys like Navarro are just sort of like a smokescreen to make you think that it's goofy stuff. But there's some really bright heavyweights that are completely against the comparative advantage free trade school. They're in a backlash. They're not slouches. So I think trade should be, especially China, should be more considered as a national security question in terms of like how far can we push China before we got to put like 3 new aircraft carrier task force into the South China Sea, of which we'll probably lose. So that's the dialogue. I think people are going to be a lot more careful about trade with China after the debacle of the trade strong arming of Japan before World War II. Yet on the other hand, I think it's unacceptable to have the drop in skilled labor. I think Canada and Mexico probably more fault than China, and Trump is set. He has to do it. He has to deliver this. He has to deliver some more jobs that can get you a bass boat and a good house and
Sure.
$100 an hour. So I think the China trade is over. Where I think it's going to happen is that there's going to be I can't work out the scenario, but I think it's going to be a Plaza Accord 2, or is it a Plaza Accord 3 now, where the yen, or not the yen, the RMB is dropped down to 3 or 4, just the same way that yen was dropped from 280 down to 110, 120. China will have to accept it, or they'll become they'll be
Oh, that's interesting. So you think massive RMB appreciation?
Yes, and I
Really?
I don't know where, it's your view is good as mine, but I think the actual Ricardo idea of trade, comparative advantage, would put the RMB down to, I don't know, I'm just pulling it out of the air, but I don't know, 350.
Okay.
And that the current yen level, or RMB, the current RMB level is a long-term Deng-inspired plan to hose the U.S. by dumping their excess capacity, given their populace, onto the U.S.
Yeah, command economies always have to export deflation. That's just a feature. So that's what they do. That's what China's been doing, and so that's interesting. I haven't heard a massive appreciation of CNY as a thesis. I would be really interested to see if that can be brought about, and if an administration, a U.S. administration, can help to facilitate that, that would be pretty amazing. I think that would be a huge win for the U.S.
Well, I think what's at stake is that there's reasons why we have Trump, for good or for bad, and the major reason we have Trump is because U.S. policy has allowed a hollowing out of the high-paying jobs. The middle class is under risk. Politicians basically could do anything. But if I were an auto worker and as I said, I can get my cabin up in upstate Michigan, and my bass boat, and my 2 snowmobiles, not to demean, or to judge their lifestyle. I was happy. You guys can do whatever the hell you want, but if I got my Teamsters and I got the UAW on my side, and I got this high pay, well, that'll end it. First with NAFTA, but especially with Japan, and now the next job set after they completely gutted the Rust Belt, what is now called the Rust Belt. The next job set is all the stuff, the solar panels, everything else that China's dumping on us.
Yeah, I think if anybody watched J.D. Vance's speech at the Republican convention, it's very much in his line of sight.
Yes.
Getting those jobs back, reinvigorating the Midwest, very much in J.D. Vance's line of sight. And I don't think, if Trump wins, and I really don't know the odds on that, the polls change every day and we're months away. But if he wins, I think that will be a massive focus for that administration if Trump and Vance win. With a Biden or ongoing Democrat administration, I really don't know what the policy is. It's kind of status quo, and it really hasn't. I just don't know what we've seen aside from some low-level services jobs that have higher wages, which is fine, but those middle-class jobs, I'm not sure that we're necessarily seeing a lot. So, okay, George, this has been great. I love diving deep into that. And we'll see if we have the July cut. If not, it sounds like you have a belief that we'll have a cut sooner rather than later. So definitely before the election instead of after the election.
It's going to be whatever you think, or the general market thinks, is going to have the most political, dramatic impact on behalf of the Fed.
Okay.
I say that's, but I guess a good case can be made with September. Their current policy is not working.
Okay, interesting. Very good. Tracy, I want to move on to talk about energy. We had some moves in nat gas this week where on Wednesday we saw, I think, an 8% fall in nat gas prices. And let me look at that chart. But yeah, I think we saw an 8% fall in nat gas prices. And today they're back a little bit. This is Thursday, so Today they're back a little bit, I think 4% or something. We have some kind of midsummer volatility there, and I wanted to kind of dig into why the fall yesterday. Is there a cause there, or is it just somebody moving money? Was there an event that drove that? Is there an event that is driving it back up today?
Natgas is kind of the redheaded stepchild of
Yep.
the energy industry.
Yeah.
So you have to know when you're trading that, there are a lot of things involved in that. We had the LNG export facility hold from the Biden administration earlier that sent prices back down, they bounced back up. We've had a lot of problems with Freeport moving nat gas from the US to the Freeport export facility. There's 4 trains involved. Literally this whole year, we haven't had all 4 trains up at once. There's been a problem with it. Then we had the hurricane. We had Freeport, Hurricane Beryl. We just had Freeport export facility down for 2 days. There's it's a lot going on with that particular product. That said, we are headed into the seasonal uptrend, and I think you have a chart I sent you with that we can show. It's about this time that we start to see an uptick in natural gas prices as we start refilling needs for our winter stock, as well as we see LNG exports kind of start driving up now as other countries start importing more, getting ready to gear up for their winter season. Right, and refilling their gas needs. And so, I think that, we hit $2. We have really good support there, technically speaking, if you're looking at daily charts. And so, I'm not gonna proclaim that we have seen the absolute low before this bounces, but this looks like a really good spot headed into the next several weeks, with higher oil or higher nat gas prices due to the fact of all the things that I just explained.
Interesting. So, that seasonal trend is very interesting. And, we've seen a 35% fall, at least as of yesterday, 35% fall in nat gas prices since June 11th. And so this mid-July decline, I know before people ramp up for the fall and winter, but this is normal. This mid-July decline, is that a normal magnitude of fall for mid-July?
Well, the fall is much greater than we generally see, and this is kind of generally where we see the market kind of bottoming. But again, we've had extraneous circumstances come about, such as a hurricane.
Yep.
And problems again with Freeport in general with their export system. We saw Waha go negative in Texas, which is not unheard of, also just because it has nowhere to go. It's kind of stuck in the Permian Basin. Again, like I said, I don't want to call this an absolute bottom, but I think this is a good place to start looking if you're trying to trade this just for the seasonal ramp. I don't know how far that ramp is going to go, but we'll see. Europe is pretty full for gas, although they still have LNG exports from the United States scheduled. So again, this is a very tricky market to play. So I generally tend to play this market via options than outright futures.
Yeah, just so everyone knows, I asked Tracy to talk about nat gas a lot, and she's like, I'm not really sure. So it's been a real win to get her to come on here today to talk about nat gas. So thank you for that, Tracy. I know it's not easy. I want to ask you about fertilizer. So if we look at diammonium phosphate prices, obviously, nat gas is an input for fertilizer. We're obviously way off the 2022 fertilizer prices, and we had a kind of March 24 peak. Do you think these nat gas prices, the decline at least this month, do you think they'll have a major impact on fertilizer prices in the down on the downside, or do you think they'll, as we see the seasonal rise in nat gas prices, do you think we'll just have the regular seasonal rise in fertilizer prices as well? Again, fertilizer is something we get questions about a lot in the comments on YouTube. So
Yeah. And I've talked about fertilizer before, I think with you, I think where nat gas prices are right now, I would not, we're not going to see a repeat of the summer of 2022 again, when we saw, huge increase in nat gas prices, fertilizer prices, then obviously followed particularly in Europe and the UK, or the EU and the UK. I don't really see that scenario happening right now. And so, I just don't think there's quite a trade there right now for fertilizer. And, and that's a good thing, that's a good thing for farmers.
Stability.
So, that's what we want to see according to this market. So, there's just no trade there unless we see nat gas prices spike for some unknown reason.
Right. Okay, that's good to know. Okay, guys, I have learned since the start of the show that Albert is in an undisclosed location. So he's not going to be joining us, but we're still going to talk about tech and bonds and VIX anyway. Okay. So I know you're not tech experts, but we're going to go through this. And Albert's had this, hypothesis for the last several months that, the Fed and the Treasury are pumping tech, they're pumping bonds, and they're killing the VIX. Okay, so as we saw tech fall yesterday, I've got a chart up looking at tech being obliterated yesterday. It's actually a tweet from an account called Axie. Looking at, we had ARM down 9% yesterday. We had NVIDIA down almost 7% yesterday. NVIDIA's back up, has recovered probably half of that today. But as we look at things like the XLK, which is the technology spider ETF, it's been up nearly 4% month to date. Now, our CM Markets forecast had it up for a 3% rise this month. So, our view is that tech is still a little bit ahead of itself. We don't think we're going to see a continuation of yesterday's fall too much further, but it still appears to be a little bit ahead of itself. So it seems like that thesis that Albert has about them pumping tech, it seems like it's back on today. But when we look at the 10-year, we see that the 10-year yield continues to fall. So they seem to be continuing to pump bonds, and they're killing volatility again today. So that trade, George, what do you think about that hypothesis that the Fed and the Treasury are taking that kind of triangle approach to goosing markets pre-election?
Well, all this industrial policy is definitely backing tech. So I would, as far as that goes, I tend to agree, and they're not small. Tracy already mentioned the IRA. We got the CHIPS Act. We got massive fabs being built. I think there's about 5 or 6 being built right now in the U.S. So yeah, they're certainly not hindering it. Now, as far as transmission into like, as far as the Fed goes, I don't see it. I don't really see the transmission channel, or the channel that the Fed can encourage tech. They've basically gone standstill with their Fed funds, and what I've talked about before. Now, observing the market, this is like, talk about a crazy week, and it reminded me a lot of long-term capital management when they went down. And I guess it's not going to happen, but I was fully anticipating somebody to say, "Whoop, we just closed down our hedge fund."
Yeah, it felt like that.
Yeah, it definitely felt like that. So I'm cautious to try to say that tech's going to go here or there or anything, given this, what are clearly zillions of cross flows between small cap, R2K, and tech. NVIDIA went down 12% odd. in 5 days, yet the S&P is only down 0.5%. Well, was only down 0.5%. I guess
Right.
down more.
Down again today.
Um,
VIX is actually up
it-
almost 9% today. So, it was up 10%
Yeah.
yesterday. It's up 9% today. So just to remind people, the VIX tells us S&P options for 30 days out, right? So it's telling us that there is an expectation that S&P may fall pretty dramatically over the next 30 days. Will that change? Yeah, it'll change. Of course it'll change. But right now it's looking like a pretty interesting month ahead.
Yeah. And as far as treasuries go, that's another hour's rant. I think
Bring
the
it
Fed
on.
kicked in. I think the Fed clearly kicked into yield curve control from January 2022 on, where the U.S. Treasuries are no longer reflective of what's evolved in the economy. And people have missed this turn, just like what I talked about earlier, the Fed. For decades and decades and decades, we could reliably look to U.S. Treasury, especially the 10-year, being reflective of the risk-free 10-year rate. It might have been a little lower, a little higher. There was sector segmentation, but in the end, it was one and the same. So people just use the U.S. Treasury 10-year rate, and all other term structure rates, especially the mortgage industry and all the other big users and abusers of credit and borrowing and lending, especially the ones that approximate risk-free, are not in accord at all with U.S. Treasury 10-year. So I wouldn't take too much. I don't think the U.S. Treasury 10-year is giving you too much input. In fact, a cynical conspiratorial view would say that the New York Fed under Williams has motivated their in-house guys to come up with this inverted to flat yield curve and negative to flat term premium, just to back up their views of being restrictive. And if clearly the New York Fed probability recession, which is based on the yield curve, is completely out to lunch. I don't know how many years you need to come to that conclusion. And it's also, that's the mentality that's leading astray most people in terms of like use of the U.S. Treasury 10-year to like what's going on with the economy. So I'm hesitant to use the U.S. Treasury 10-year as any sort of tell on what's going on with the economy.
Interesting. So what term do you use? You looking at the 5-year, the 30-year, Fed funds rate? What's the most useful for you?
I've been on a quest that has really, defeated my tool chest. And I remember that there was always these like very nerdish guys, respect to your handle, very nerdish guys that were up on the 12th floor that would come up with, various Nelson Siegel and this term structure model, and that term structure model. And we would just wave them away because, they might be academically right and write a good paper on it, but it had nothing to do with how to survive from Monday to Friday.
Right.
Or even a quarter. So forgotten. But now I think that's the answer to try to figure out what actually is the term structure in the United States. I bootstrap it right now by saying, well, okay, mortgage-backed securities from Fannie Mae and Ginnie Mae and Veterans Administration, they are risk-free. Certainly the Fed thinks so because they own so money. Therefore, I take, okay, how is the mortgage-backed security current coupon level determined? So that puts me upstream to where conventional and compliant 30-year mortgages are. And that is how I bootstrap into what I think the 10-year risk-free rate is. That comes up with a pretty satisfying, positive term structure and also comes up with a positive term premium.
So what's the rate that you're looking at? Like, what's the ballpark?
It's the U.S. Treasury 10-year is right now about 100 basis points, 1% below what I think what I loosely call, and again, I'm naive in this. I wish I paid more attention to those characters 20 years ago, but it's about 1% below what I call the actual risk-free rate in the United States. That's the risk-free rate that explains the economy and cost of funds and has the U.S. Risk-free status as the keystone for estimating everything from, CAPM to equity to, tech or whatever. That's a really serious problem. That goes right back to my, it's almost as serious as my view on the Fed monetary policy, because for about 2 years now, people have been really led astray by their habitual use of the U.S. Treasury 10-year as their major macro or monetary policy indicator.
Okay, so if we're undervaluing risk by 100 basis points, there's a lot of risk. There's a lot of value that's not being accounted for, right? I mean, we're screaming
Oh yeah,
risk, right?
You just get to, in the, basic CAPM and very, very journeyman type of portfolio things. Yeah. And you think about it, Tony, that makes sense, because NGDP has been 5 to 7% for the last couple of years. It looks pretty stable. The Atlanta Fed GDP now just went back up well over 2%. I think a guy not as bright as me would say, hell, we're in a bull market. Like we're in an economic boom.
A lot of guys are saying that. Yep. Hey, Tracy, before we wrap this up, I just want to get your thoughts on this, and then we'll close it out real quick.
But as far as, I think there's a lot involved what's happening in this trade right now, whether you want to call this a rotation into small caps versus Nasdaq. But I think there's a lot more involved, whether the Fed buys or not. That's kind of aside right now, because what's happening with this is that this rotation is forcing hedge funds to get rid of their positions. The boat was very overloaded to one side.
Yep.
And this is just forcing people into small caps, whether they want to be or not. This is
Right.
what you have to do to balance your portfolio.
Yep.
So I don't know if the Fed can necessarily go in there and buy whatever they want when you're talking about huge money here being forced into a different side of the market.
Yeah, it's a much more complicated market, it sounds like we're turning into. So, guys, thank you so much. George, thank you so much for joining us. Tracy, thank you so much for joining us. We missed Albert, and we'll give him a hard time about it. And really appreciate this. Have a great weekend. Have a great weekend, guys. Thank you so much.
Thank you.
Thank you, Tony. Good to meet you, Tracy.